Welcome to our High Rock monthly video. I am Scott Tomlinson, and with me is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock's certified financial planning professional, Bianca Tomlinson. Well, as you all know, we have three investment models from which we apportion an allocation percentage to each client portfolio based specifically on our respective goals and the time horizon required to achieve those goals and our tolerance for the risk and the potential for volatility that may be required in achieving those goals. Well, our wealth forecasts are intended to capture our long-term goals in a plan that then becomes the basis for our respective investing strategies. We always stress the longer-term outlook for your time horizons, and although we do have to report your portfolio performance through each quarter of the year, we remind you that these reports are simply a snapshot in time. Now, part of the journey that ultimately leads to our goals and to our end goals. Our portfolios have bounced back nicely through the first 4 months of 2019 after a fairly difficult 2018. And depending on your specific allocations and the level of your portfolio's investment, they are running at an annualized rate of between 15 and 18% at the moment. However, we do not think that this is necessarily sustainable. In fact, we continue to be cautious about what is to come. And of course, we always manage risk first, because why would you want to take more risk than is necessary to reach those goals and potentially put those goals in jeopardy? And as you know, we focus on the return per unit of risk taken as a key metric in the management of our portfolios. Well, a common question that comes up when we talk about being cautious in our conversations with our clients is, why are stock markets doing so well, and is that not telling us that the economy is also doing well? Well, not necessarily. Central bankers are continuing to paint a rosier outlook than may appear to be the case by calling current economic weakening trends transitory and temporary. Now, they continue to be worried about the psychological impact of a stock market sell-off, convincing many that they will act to curtail it as they did earlier this year, which gives equity market investors a false sense of security when the fundamentals suggest that stocks are overpriced and represent significant risk. Now, we all want stock markets to go up because we own stocks in our portfolios and the capital appreciation pushes our portfolio valuations higher. But we also have to be careful when stocks get overvalued, as they did last year, because the resulting sell-offs can be quite frightening. And the chart we're looking at here tells us the story of how before the financial crisis, there were offsetting correlations between stock and bond markets. Strong economies pushed bond yields up and stocks went higher. Weak economies did the opposite. But in response to the financial crisis, central banks undertook a period of extraordinary monetary policy to add liquidity to the financial system. Now, the relationship that drove stocks was not necessarily just economic growth, but a lot of money chasing equity assets. Now, the correlation between stock prices and bond yields has become altered. Paul, any comment on this?
Well, it sure has opened up a gap there to the right over the last number of years, and I think if we look at an even tighter timeline graph, Scott, over the past 3 or 4 months, we would see that stocks have, they're at their all-time highs effectively, and yet bond yields are 10-year yields are below 250 today. They're at 245. So I guess at the end of the day, what this is telling us, and I just read it in the paper, I think this morning, the bond market is telling us something. I guess we're somewhat unsure what it's telling us, but for you and I, it's telling us that perhaps the economy is weaker than the equity market thinks. And at the end of the day, perhaps we'll see in the next slide or two, equity markets are driven by cash flow from operating businesses. Well, we'll continue to see how earnings perform here over this first quarter earnings season, which we're in the thick of right now.
Sure, and it's about the fundamentals, but yeah, we'll definitely get to that in a second, because the fundamentals have been in the past the catalyst for stocks, like the ability for corporations to earn profits, and that seems to have taken a back seat to the liquidity issue, and certainly stock buybacks, as you and I have chatted about earlier today. But earnings have been actually going through their own recession over the last couple of quarters, and are only expected to average growth of about 3.5% annually over the next couple of years. So as far as the fundamentals are concerned, that doesn't seem to jive with stock prices rising to all-time highs, as you just said. And something else that comes to our attention is what we call stock market breadth. When stocks are moving higher, both large companies and small companies tend to move up in tandem. But when and that represents what we would classify as wide stock market breadth. But stock market breadth is narrowed significantly when only a few large companies are moving higher and smaller companies are being left behind. Any comment?
Well, yeah, one quick one. Unfortunately, we don't have a graph on it, but I think we showed it in one of our quarterly comments letters to clients back in either the fourth quarter or the third quarter of 2018. But if you look at the S&P right now, these so-called FANG stocks, which are Facebook, Amazon, Apple, Microsoft, Netflix, Google, they are about 18% of the entire valuation of the S&P 500. And that's actually very similar to what it was back in the year 2000 with the tech stocks of the day, such as Intel, Cisco, Microsoft was in there. So these stocks are enormous. They're almost 20% of the entire index. So goes the FANG stock, so goes the S&P 500. But you're right, small cap have been somewhat left behind here.
And perhaps we should be focusing more on the small cap as to give us some kind of economic direction, because most of the large cap, a lot of the large cap companies have been doing share buybacks, which perhaps obviously do drive share prices higher, but perhaps, again, not fundamentally so.
Yeah, and small cap, following some small cap companies does give us, you're right, it's a good point, gives us a window to look into on the macroeconomic environment. I'm not sure Facebook is actually a really good barometer of how the overall economy is doing.
And another thing from economic statistics, we've seen some negative economic statistics and some positive economic statistics over the last week or so. One that we consider to be a leading indicator, perhaps, and something that can be a bit telling is the purchasing manager surveys, and that has been showing some deceleration in growth, and again, it takes time before the actual economy starts to show this in something like its annual GDP growth rates. But other people have asked me, so what about the employment numbers? Employment's been strong. We continue to see strong employment, low unemployment. But the reality is that unemployment and employment are lagging indicators. So the economy will move up and down, and employment will tend to follow. As you can see, and it's very graphic here as to what happened in 2009, 2010, but you can see the economy falling, employment and unemployment, or employment growth falling significantly, unemployment rising. And then after the economy starts to rise again, employment follows. So employment and unemployment are lagging indicators, and so they're not a good read necessarily on where we see the economy is going. Further, we look at the Fed, and the Fed has decided to stop raising rates, and there's a reason behind that. Again, they're telling people that they think it's temporary and transitory, but they don't want to say that their outlook is gone more negative necessarily. They don't want to give that impression because it does impact people's psychology as far as their confidence in the economy and what they're going to do, whether they're going to spend or invest. But finally, Paul, back to bonds again. we follow and monitor these yield curves because they do tell us something. But there's definitely some inversion that's happened, and in the past, inversions have pointed to significant slowdowns in future economic growth. And here's the U.S. yield curve right here, not completely inverted, but certainly there's a fair bit of inversion, and certainly in the belly of what we would call the belly of the yield curve, out to about the 10-year level, there is some inversion, right?
Yeah, that's the dark green line. That's 2019, and the lighter green or yellow line above it is 1 year ago, 2018. So yeah, there is some inversion, and we've shown this. We've shown in not this exact chart, but inversion charts overlaid with U.S. recessionary periods in the past. And it's quite obvious that when the yield curve, it doesn't necessarily have to invert, and in fact, the yield curve starts steepening just before a recession begins. And the reason being is that if we look at the Fed funds rate, the overnight rate that the Federal Reserve Board can actually affect, they've, as you said, Scott, they've arguably stopped raising rates. I mean, their next move quite easily could be, if the economy slows and shows a sudden slowness, is to cut rates. And that yield curve will start steepening again for sure, because those very front end parts of the yield curve, the 1 month, 6 month, 1 year, 2 year, will start going down in yield. So we could actually see, now all rates could go down, but those would go down faster than the 10-year and 30-year parts of the curve. So, everybody started hopping on board the last few months about an inverting yield curve, but in fact, it's a steepening yield curve that is really the beginning of a recession. And one other thing about rates, Scott, too, as they relate to the equity market, perhaps one of Warren Buffett's biggest indicators of stock market valuation is something called the Fed model, which effectively takes the earnings yield of the S&P 500 less the U.S. Treasury bond yield. And, his way of thinking, equities are cheap because the interest rates or government bond yields are so low. And there is some truth to that, because you can see how money flows from one asset class to the other. So as government bond yields go down, you get yet less yield. So you go in search of other asset classes that pay you a higher yield. But at this stage, arguably it was cheap January 1st, but not so cheap anymore today, given the move we've had, and now still darn close to all-time highs.
And Canada, the Canadian economy is definitely slowing, and the Bank of Canada is on hold, still positive again about the future, but that also could be under a little bit of suspicion, because we can look at the Canadian yield curve and it looks pretty much the same as the U.S. yield curve. It's definitely telling us something, and as you said, if we start to see more economic weakness in either Canada or in the United States, that front of the yield curve is going to start to come down, and we'll see probably some positive and some steepening of the yield curve. So we see warning signs from the bond market. We know that bonds lead all financial markets, so it's our fiduciary responsibility to our clients, to ourselves, to stay focused on the fundamentals, and perhaps we have to stay away from the emotion attached to stock markets, and not let them dictate how we invest at this juncture.
And we are still investing. Obviously, we have added some risk over the past month. We bought $1 bond that's paying us pretty stout yield. We also bought a industrial chemical company's stock that actually pays a very stout yield and a dividend yield. So we're trying, again, Scott, you always phrase it, but we're trying to find non-correlating assets that pay us good yield through their intrinsic cash flow.
As is the case, we're looking for value in a market where it's difficult to find value at this point. But things will change, we know, as they do, as the cycle evolves, and there will be opportunities, and of course we will be there to take advantage of them. Anyway, that's going to be it for our monthly video. Thank you very much for taking the time to tune in. And on behalf of Paul and Bianca, I would wish you the best for the month of May. And if you're anywhere in Canada, probably you are looking for some warmer temperatures. So let's hope for those too. And that next time we're talking, we're hopefully getting a lot closer to summer. Anyway, all the best from us.